Every trading decision is made within a context, whether the trader recognizes it or not. That context defines direction, shapes risk, and determines whether a reaction on the chart has meaning or is just noise. Without a clear sequence, even solid technical ideas lose consistency. Welcome back to the ComLucro channel. In this video, we will build that sequence step by step. You will see how top-down analysis establishes context, how structure and liquidity define where reactions are likely to occur, and how changes in market behavior signal real shifts in control. The goal is not to add new tools, but to understand how these concepts work together as one clear and repeatable process. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before looking for entries or confirmations, the first step is to understand where the market is operating. That perspective is built by analyzing the chart from higher time frames down. By starting with higher time frames and gradually moving to lower ones, we gain clarity on direction, context, and the areas that truly matter. This approach allows us to filter noise, avoid conflicting signals, and make decisions within a clear structural framework. However, it's important to note that starting from the monthly time frame and trying to apply every single concept can clutter your chart when you reach your entry time frame, making it ineffective. In this video, we will guide you on exactly what to look for in each time frame to conduct a well-informed analysis of any chart with ease. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1, overcoming directional confusion. On the 5-minute chart, the market often appears choppy with no clear direction, continuously violating structure levels, both upwards and downwards. This can confuse any trader trying to identify the trend. However, if we zoom out to the 1-hour time frame, the market trend and bearish pressure become evident. This area is the same as the one observed on the 5-minute chart. By knowing the higher time frame directional bias, we can confidently take short entries on the 5-minute chart. Remember, if you are confused about the direction and the market keeps violating key structure levels, you're likely focusing on the wrong time frame. Analyzing the bigger picture helps enhance your ability to make more precise and confident entries. Number 2, increasing accuracy. A minor reaction to a higher time frame key level can lead to a significant trend change in the lower time frames. Before placing any trade, we should check how much room we have before reaching a higher time frame supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. For example, on the 15-minute chart, we saw a strong bullish move with a clear fair value gap between the shadows, resulting in a valid order block, a great opportunity to go long. However, the market suddenly changes direction, ignoring the demand order block. Zooming out to the 1-hour time frame reveals that this change could be due to reaching a higher time frame key level that acted as strong resistance multiple times. Checking higher time frame key levels helps avoid unnecessary risks. Conversely, in another 1-hour time frame example, a move with obvious inefficiency breaks above the previous market structure. If the price pulls back to the order block zone, it offers a perfect opportunity to enter a long position, set a stop below the swing low, and target the next market structure level. On the 4-hour chart, we recently broke above these supply areas, indicating that demand is in control with enough room to reach the next unmitigated supply area. Combining higher time frame levels and directional bias with a lower time frame entry setup can make for a perfect trade. Number 3, optimizing trade entries. Analyzing multiple time frames allows traders to identify optimal trade entry and exit points. For instance, imagine waiting for the price to pull back to the order flow area and opening buys to align with the bullish momentum. Setting buy orders at the beginning of the zone may result in a large stop. An optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps get into trades at a better price, reduces the likelihood of false signals, and increases the trader's confidence in their analysis. At this point, we understand how higher time frames provide direction and context, and why aligning entries with that broader picture improves accuracy. But knowing the direction alone is not enough. We also need to understand where price is likely to react within that context. This is where supply and demand come into play. These zones help us identify the specific areas on the chart where institutional activity is most likely to occur, and where reactions, continuations, or reversals tend to form. To see how this works in practice, let's start with the classical concept most traders are familiar with: support and resistance, and then build from there. Let's start with the basics: understanding support and resistance. Support and resistance are zones where the price has reacted previously and may react again in the future. On the chart, you can see the price pushing up, hitting a certain area, and reversing. This area is known as resistance, indicating that sellers have initiated short positions while buyers have closed their long positions, causing the price to reverse. Similarly, when the price pushes down, hits a particular area, and reverses, it creates a support zone. This indicates sellers closing their short positions and buyers opening long positions, which causes the price to reverse from this area. Once we understand the classical concept of support and resistance, it's crucial to address the role of stops, not just as a protective measure, but as a cornerstone of emotional control and trading discipline. Phil Goedicke, known for his practical and experience-driven approach, offers a powerful perspective on this.
Stops are a must. I mean, we all have to use stops. Now, I personally rarely use hard stops, but I have mental stops on every position that I take. Basically, if something's breaking support or resistance, I usually just exit that trade. And I think most of us here need to have a mental idea in our head of where we're going to exit a trade, based on where it goes against us. How many of us here have ever been in a losing trade and we're down something small, maybe $5,000, and we think, I'm not going to cut it. I feel like this is going to be a winner, and we add to that trade. An hour later, we're down $20,000 to $30,000, and we think, wow, it's hard to, I can't cut it now. We hold it till the afternoon. Maybe tomorrow it gaps up, we're down $70,000, $80,000, $100,000, and we think, what the heck just happened? I could have cut that loss yesterday for $3, $4, $5 grand. Now I've given up 10, maybe 20% of my year just by being stubborn. Think about how much more money we could make at the end of the year if we just stick to some simple rules and cut our losses at an appropriate place.
This insight sets the stage for identifying higher quality zones and making disciplined entries. Now, let's move into smart money concepts and how to recognize those key supply and demand zones on the chart. Next, let's discuss why we should mark these zones on the chart. Here are 3 crucial reasons. First, levels where the price has previously reacted are likely to be rejected again, so we observe these levels closely for potential rejection. This helps set profit targets, especially if they are key levels on higher time frames, as even minor reactions here can lead to major reversals in lower time frames. Second, determining market direction. When the price breaks through a resistance level, it shows that buyers have overpowered sellers, indicating bullish momentum and a potential upward continuation. Similarly, breaking below a support level indicates bearish momentum, so we align our trades with the dominant trend. Identifying the direction is the first step when we open the candlestick chart. Third, identifying liquidity. We know that when the price reaches support and resistance levels, price action traders seek trading opportunities. Break and retest traders will buy if they see rejection signs in the zone, placing their stops below this level, anticipating upward continuation. If there isn't enough liquidity to push the price higher, the market might break below this level, grab the liquidity, and continue rising. So having our entry below this level can provide double confirmation of the moves we anticipate. Traditional support and resistance are also considered liquidity areas. Now let's explore supply and demand in smart money concepts. Supply and demand areas form when smart money enters the market, causing significant price movements. A demand zone cannot be identified when multiple small candle rejections occur, but a valid demand zone is confirmed by large candles indicating strong buying pressure. These momentum candles suggest the presence of large institutions, banks, and hedge funds. essentially the smart money in the market. Similarly, a valid supply zone forms when there's aggressive bearish momentum. So how do we gauge the aggressiveness of price movements? By identifying fair value gaps on the chart. We won't go into detail here on how to perfectly identify a fair value gap of 3 or 4 candles, as we have a specific and detailed video on this topic. I invite you to watch that video for a deeper understanding. Continuing on, the larger the gap, the more aggressive the movement, indicating an imbalance between buyers and sellers and the entry of significant money into the market. Typically, prices revisit these areas to fill orders left behind, restoring balance. Another key factor in validating a supply or demand area is the break of a structural level to confirm momentum, providing crucial insights for making informed trading decisions. Understanding supply and demand helps us identify where price is likely to react and where institutional activity may be present. Fair value gaps, momentum, and breaks in structure give us clues about aggression and intent. But identifying a reaction zone alone does not tell us whether the market is truly changing direction or simply pausing within the same trend. This is where change of character becomes essential. While supply and demand define important locations on the chart, change of character helps us read behavior. It shows us when momentum begins to shift, when control starts to transfer, and when the broader market environment may be transitioning into a new phase. Now, let's begin. What are the basics of change of character? A change of character, or chalk, occurs when the dominant market momentum begins to fade, signaling a potential transition in trend and order flow. This shift often marks the moment when buyers lose control and sellers step in, or vice versa. Technically, it appears as a break in the most recent structure, suggesting that the market environment may be changing. Now, let's see how we can identify a valid change of character in the market. In a bearish scenario, a change of character takes place when the price breaks and closes below the most recent major low and the latest demand zone. The same concepts apply to a bullish scenario. For example, when the price was in an uptrend, consistently forming bullish structure breaks, a shift occurs when it breaks through the most recent major low in the demand zone, signifying the first change of character. The downward momentum continues as the price pushes through the next demand zone and higher low, resulting in a second change of character. This dual change of character suggests an impending shift in market structure. Now, we can anticipate the price entering the bearish order flow. Consider this crucial point. Every time a zone breaks, an opposite side zone automatically forms. Since the price has broken several demand zones, a supply zone has been created at the extreme. Therefore, our expectation is for the price to push higher toward the extreme supply zone. If the price reacts to this zone, we can enter the market by placing sell positions. Our anticipation for the price is to form successive bearish breaks of structures to the downside. To fully grasp why these movements occur, it's essential to understand the psychology behind the change of character, or chalk. This involves recognizing the behavior of retail traders and institutions. Large players use these character changes to create false breakouts and capture retail traders' stop-loss orders. Retail traders tend to follow predictable patterns, placing their stop-loss orders at support and resistance levels. This happens because many traders use similar strategies based on classic technical analysis that indicates these points as key levels for loss protection. When a large number of stop-loss orders accumulate at a certain level, it creates a liquidity zone that can be exploited by the market's big players. These big players, or smart money, know that these points are vulnerable and can move the price to these liquidity zones to cause false breakouts, activating stop losses and creating an opportunity to enter the market at a more favorable position. These behavior shifts and false breakouts are not random events. They occur because price is constantly moving through phases, responding to liquidity and transitioning between states of control. To fully understand when a move is meaningful and when it is simply noise, we need to step back and look at how price is structured as it moves. Before we close, it is important to revisit the fundamental way price action unfolds on the chart. This broader perspective helps place change of character, liquidity grabs, and momentum shifts into their proper context. Price action is composed of three main sub-movements: impulse, correction, and continuation. And each one is created by internal candlestick patterns. So let's break them down one by one, starting with impulse moves. Impulsive movements are strong, decisive pushes in the direction of the dominant trend. They appear when price accelerates clearly, either driving upward in a bullish leg or falling sharply in a bearish one. This phase is powered by firm market sentiment and obvious control from buyers or sellers. For instance, look at this bullish candle sequence. We can see price climbing through a combination of smaller impulses and brief pauses. Together, these create the internal structure of what we classify as a single bullish impulse leg. And why is this treated as one smooth movement? Because at no point along this path does price break or even sweep the liquidity beneath any of the previous internal lows. That specific detail is what keeps this entire leg categorized as a clean, uninterrupted bullish impulse. From a candlestick standpoint, we label this internal movement as our impulse leg. After that, a valid pullback appears, confirmed by this red bearish candle that breaks and closes below the previous bullish candle. This marks our minor correction. Price then builds another bullish impulse, which we call a minor continuation. This sequence repeats over and over again: impulse, correction, continuation, until price reaches this swing high and eventually transitions into a deeper corrective phase. Now let's move to the corrective movement. A corrective move is a temporary counter-trend phase or retracement that moves against the main direction of price. We identify a correction when price breaks below the most recent pullback or internal low, or sweeps its liquidity through a candle wick. In this example, 3 red candles form the correction, clearly breaking and sweeping the previous pullback's low. After this, price returns to its upward movement and eventually breaks above the most recent swing high. This confirms the start of the continuation phase. However, in this scenario, if price fails to break the most recent pullback or internal low and instead continues driving upward, then we do not have a valid corrective movement. In that case, this entire sequence should be viewed as one continuous impulsive leg with no correction in between. It is essential to remember that these rules apply across all time frames and on any chart built from pure price action. Now let's move on to one of the most important components of market structure: the market structure shift. Imagine the higher time frame trend is bearish, with price forming a pattern of lower lows and lower highs through a series of impulse and corrective legs. If we zoom in to the most recent retracement or corrective phase on a lower time frame, we may see price building a short-term bullish structure like this. During this retracement, what we want to see is price pushing into a key higher time frame resistance zone and showing rejection. This resistance could be a bearish fair value gap, an order block, a breaker, or a mitigation block. If price then breaks below the most recent pullback formed just before tapping that resistance area, we get a market structure shift on the lower time frame. This shift suggests that the temporary bullish move is likely ending and that bearish momentum is returning. At this point, price is expected to realign with the dominant bearish trend of the higher time frame. And it is crucial to understand that for the structure shift to be valid, price must clearly break and close below the swing low of the most recent pullback. A wick that only touches or penetrates the level is not enough. We need a full close beneath it to confirm the shift. Now you might be wondering how we can confirm whether this bearish move is a true structure shift rather than just a normal bearish correction before the next push upward. The main reason we classify this specific move as a market structure shift is that price tapped into an unmitigated resistance zone, such as a supply area, a fair value gap, or a breaker, and then reacted sharply from that level. It's important to understand that not every corrective leg qualifies as a structure shift. For the shift to be valid, the move must originate from a key unmitigated level on the higher time frame. This is why a solid understanding of market structure is so critical. Without it, you are far more likely to misread the chart and expose yourself to avoidable losses. Now, once the bearish structure shift is confirmed and we anticipate lower prices, the next step is to search for a selling opportunity. At this stage, you will want to locate a bearish fair value gap, an order block, or an inverted fair value gap formed within the structure shift leg. These zones often act as magnets, drawing price back into them before the move continues downward. In that situation, you would place a sell limit order and target the closest liquidity pool on the current time frame, or aim for higher time frame liquidity levels if you are pursuing a larger move. When these concepts are viewed in isolation, the market feels complex and unpredictable. But when context, location, behavior, and structure are understood as part of a single process, price action becomes clearer and easier to manage. This is how consistency is built, not by predicting every move, but by reading the market in the right order. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.